Good day, this is the Asymmetric Daily Brief for Tuesday, August 11th, 2026. Here is the shape of it. A Bitcoin mining company called Riot Platforms filed its quarterly numbers yesterday, showing a net loss of $237 million on $174 million of revenue. It lost more money than it took in. And today its stock rose 17%, because alongside those numbers, it disclosed a 20-year, $9.1 billion power lease to a frontier artificial intelligence lab. Nobody was buying a Bitcoin miner today. They were buying a landlord. That is the day in one trade, and it tells you the artificial intelligence story has quietly stopped being about chips and started being about two things nobody can conjure on demand: the money to build and the power to plug in. Then the board, three places we think consensus has this backwards: the macro regime, sentiment, sectors, the calendar, and the calls. The board, the S&P 500 added about 0.1%. The Dow added 0.1%. The Nasdaq added roughly 0.3%. In other words, equities did essentially nothing today. The bond market did everything. The 10-year Treasury yield rose to 4.73%, its highest level since January. The 30-year sits just above 5.2%. Gold is near $4,382 an ounce, easing modestly. And we quote the level and the dollar driver rather than a percentage, because the percentages circulating are contested. Bitcoin is near 64,300, capped below 65,000 for a fourth attempt. Ether is near $1,889 and is the weakest major. And in energy, West Texas Intermediate sits near $82, while Brent sits near 92. Hold that gap, because that spread is doing more explaining than either price on its own. Consensus versus the asymmetric. First read, and it is the most important thing in this brief. Everyone believes Bitcoin miners are a broken trade. Bitcoin is stuck at 64,000. It has failed at 65,000 four separate times. Mining margins compress every year, and these companies burn cash buying machines that go obsolete in 18 months. That was the settled opinion, and it was reasonable. The tell says they were never mining companies in the first place. Here are the two numbers. Everything Riot Platforms owns, every building, every machine, every dollar of cash, totals $3.26 billion of assets, straight from its filing with the Securities and Exchange Commission. The lease it disclosed is $9.1 billion of contracted revenue running through June of 2048. One contract is 2.8 times the entire company, and it is not the only one. A 50-megawatt agreement with a MD signed in January takes the total to roughly 241 megawatts committed and near $9.8 billion contracted, against annualized revenue today of about $683 million. That is roughly 14 years of current revenue sitting in backlog, and none of it depends on what Bitcoin does. The mechanism is simple once you see it. The scarce input in artificial intelligence was never the chip. You can buy a chip. You cannot buy an energized, permitted, grid-connected industrial site, because the queue to connect serious power to the American grid is measured in years. Miners spent a decade accumulating exactly that asset for an entirely different reason. Second read, everyone believes Nvidia just unlocked $500 billion. On Monday, the company said it had signed agreements with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR to establish financing platforms aimed at mobilizing more than $500 billion of third-party capital for artificial intelligence infrastructure, using compute itself as collateral. Read as a demand unlock that is unambiguously bullish. Nvidia's own stock fell about 2.8% on the news. The market priced it as risk transfer, not revenue. And there is one honest reason to respect that verdict. Nobody knows how to mark a used graphics processing cluster. The depreciation on this hardware is set by the release schedule of the thing that replaces it, which means the collateral value, the single load-bearing input in a $500 billion structure, is the one number no lender can underwrite from history. Note also what Nvidia actually said in its own words. These are memorandums of understanding, subject to the execution of definitive agreements. No dollar figure is committed. No timetable is disclosed. The vendor financing comparison from the telecom era writes itself here, and we would flag it as an analogy worth watching rather than a prediction. When a vendor helps arrange its customers' financing, the revenue gets easier and the receivable gets harder. Third read, everyone is trading the equity tape, and the equity tape moved a rounding error today. The regime is being decided in the bond market. The 10-year went to 4.73%, the highest since January, and the move is oil-driven. Crude ran hard through July as talks between Washington and Tehran broke down, and the market is now pricing that into inflation expectations rather than into growth fear. That is the uncomfortable configuration. Rates rising for a supply reason, which monetary policy cannot fix and can only respond to. And the tell nobody is pricing. The volatility index sits near 15.5, with a live shipping lane conflict, an inflation print in the morning, and a Federal Reserve official this week saying plainly that inflation is too high and that the message is consistent across business contacts. Something in that set is mispriced. We would say the direction of the surprise is genuinely unknown. The complete absence of any premium for it is not. Follow the money. Rates and inflation are now a single trade, and oil is the transmission channel. Look again at that spread. West Texas Intermediate near $82, Brent near 92. That gap is far wider than normal, and it is telling you exactly what is wrong. West Texas Intermediate is landlocked American crude. Brent is waterborne. When the Strait of Hormuz is the problem, the world pays for shipping risk, and the American storage hub does not. Iran and Oman are reported to be close on a shipping arrangement, but Tehran has warned it would not mean an immediate reopening and has rejected direct talks with Washington for now, while demanding the naval blockade be lifted. And underneath all of that, the United States Strategic Petroleum Reserve has fallen below 300 million barrels, its lowest level since 1983. The buffer is thinner than the story assumes. On the dollar and gold near $4,382 an ounce slipped modestly today, and the driver was mechanical. A firmer dollar and higher real yields make a zero-coupon asset less attractive at the margin. That is the whole explanation. The structural bid underneath it, central bank buying and reserve diversification, has not gone anywhere. It simply does not win on days when yields do. And the Federal Reserve conversation has genuinely moved. 6 months ago, the debate was how many cuts. This week, the question of whether they might have to hike is being asked out loud by serious people, and market positioning does not reflect that it is being asked at all. A word on sentiment, drawn from aggregate market and social sentiment monitoring rather than any single source. The dominant conversation today was the Nvidia financing structure, and the sharpest version of it was a genuinely good observation. Bankers historically resisted taking graphics processors as collateral precisely because the depreciation is unpredictable, since a new chip can obsolete an old one overnight. That is exactly right, and it is exactly what this structure now papers over. The second most shared thread was policy on the crypto market structure bill, where an official quote about being fully committed traveled far and wide, while the actual mechanics did not. And the third was a veteran trader publishing a specific path for long-dated yields. We will come back to all three. The pattern worth naming is that positioning is being discussed everywhere and duration risk is being discussed almost nowhere. And since it drove so much of the conversation, the policy story deserves the correction. The Senate has scheduled a vote on the crypto market structure bill for September 15th at 2:15 in the afternoon. That vote is procedural. It is a cloture vote on the motion to proceed. It needs 60 votes, and Republicans hold 53 seats, which means at least 7 Democrats have to cross the aisle before the bill is even debated on its merits. Meanwhile, prediction, markets price the odds of the bill actually being enacted this year at about 21%, down from 82% in February. TD Cowen puts enactment at 25%. Galaxy Research cut its estimate to 30%. So a scheduled vote and a likely law are two very different statements, and only one of them is true. In crypto, the notable thing today is a divergence. Bitcoin near 64,300, failing at 65,000 for a fourth time. Ether near $1,889 and the weakest of the majors, and meanwhile the mining equities ripped higher. The coin and the companies that used to track it went in opposite directions on the same day. Part of the explanation on the coin side is supply. There is a large corporate holder that has become a documented, calendarized weekly seller distributing Bitcoin to fund dollar-denominated obligations. We are stating that qualitatively rather than quoting figures because we have not independently re-resolved those numbers today. But directionally, a known scheduled seller is consistent with a ceiling that keeps holding, and it makes the divergence more interesting not less. The equity story stopped being about the coin. Sectors in play, Bitcoin miners and artificial intelligence infrastructure, produced the only real move. The bull case is contracted, multi-decade, credit-like revenue attached to assets the market had valued at close to scrap, and the read spread across the peer group, with several analysts raising targets the same morning. The bear case is the arithmetic. $9.1 billion is contracted, not collected. The first 96 megawatts does not energize until the end of 2027, and the full 191 megawatts is scheduled for June of 2028. Between now and then, that $237 million quarterly loss still has to be funded, against $471 million of cash. The business model repriced today. The cash flows did not, and the gap between those two things is about 2 years long. In semiconductors, the financing question is now the stock question. And in energy, the durable version of the trade this cycle is generation and interconnection, not the barrel. Oil at $82 to $92 on geopolitics is a headline risk trade that reverses on a single wire story. The TEL consensus for tomorrow morning's inflation report is a rise of 0.1% from June to July, in a month when oil rose more than 20%. Those two facts are hard to hold at the same time. The reconciliation is lag. Retail gasoline follows crude by roughly 2 to 4 weeks, so a mid-July spike lands mostly in the August report, not tomorrow's, which means the forecast is probably reasonable and the risk is stacked 1 month out. In a print almost nobody is positioned for yet, so there are 2 ways to be wrong tomorrow and only one of them is priced. If July runs hot, the pass-through started earlier than the models assume and the 10-year has more room to move. If July comes in benign, the market reads it as all clear at exactly the moment the real pass-through is still in transit. With volatility this low, the second outcome is the more dangerous one, because it buys another month of complacency into a report that has a mechanical reason to be worse. On the radar, tomorrow at 8:30 in the morning Eastern, the July Consumer Price Index, the week's real event risk. Producer prices follow this week and will confirm or break the pass-through story from the other side. The Iran and Oman shipping arrangement remains live, and even a partial reopening resets the entire chain from oil to rates to equities. September 15th brings that procedural Senate vote. And the dates that matter most for today's lead are the end of 2027 and June of 2028, when the contracted power actually energizes. Now the scorecard, 4 new falsifiable calls dated today. 1. By the 30th of June 2027, a majority of the 5 largest listed Bitcoin miners will derive more contracted forward revenue from non-mining compute and power leases than from mining. 2. Tomorrow's inflation report prints at or below 0.2% headline, and the August report prints above it. 3. Nvidia does not disclose a committed dollar figure of its own capital into those 6 financing platforms before the 31st of December. 4. The Crypto Market Structure Bill is not enacted into law in calendar 2026. All 4 grade from public data, and we will mark them in public. And the most interesting thing today was not the loss or the rally, it was the duration, 20 years. A frontier artificial intelligence lab in a field where the state-of-the-art turns over roughly every 18 months just signed a 20-year lease. That is a company telling you it has no idea which model it will be running in 2046 and complete certainty that it will need the power to run it. That is the honest shape of this cycle. The models are speculative. The electricity is not. So the question worth sitting with is this: if the durable asset in artificial intelligence turns out to be a power contract rather than a chip or a model who has been quietly accumulating that asset while everyone argued about the chips. This is research and education only. It is not financial advice. I'm Earl, the asymmetric signal, one contrarian read a day. Subscribe.